Chicago, Friday, December 16th. I'm Killer. Let's talk markets really quick and get into the zone, the cash money zone. So we've seen a wild week, folks. You know, it all started, I think the market is essentially losing its patience. So they came and hit that euro currency on Monday, right? And all of a sudden you saw the gold liquidation, the oil liquidation. Where are they going? They're buying these treasuries, the continual grab for treasuries, as well as US dollar. We're seeing that US dollar for the first time in 11 months tick above this 80 level. You know, and Evan McDaniels at Sell Puts has talked about this dollar trade. He was all over it, that 78.20 level, but we're seeing this go up and test potentially that January high. I think it was 80.63, I believe those numbers. So we're seeing that, as well as the 10-year hunkered down here at 185. Is that 1.67% on the target? Absolutely. We're going to continue to see this trade, but I think the paramount issue here today, what we're looking at, is it is year end. And we talked about this earlier, and Steve Grasso and I just talked about in CNBC halftime report, but the year end situation is very interesting, that we are seeing this grab for treasuries, this flee into the dollar, just due to the fact that we're in a holding pattern. People are very concerned about the uncertainty continued in Europe. So as long as Angela Merkel is in a holding pattern, you're going to see investors in a holding pattern. Holiday week next week, so we're going to see this grab for treasury continue. Now, in the event we do get some bad news out of Europe, because all this move has happened over no bad news. So in the event something negative comes out, or borrowing costs continue to go higher, despite the fact they are seeing some major bond buying. I don't know if it's ECB, if it's the banks that are lending money from, or excuse me, borrowing money from the ECB at 1%, but no doubt about it, we are seeing those yields come down a little bit. But if we have any negative news, you're going to see further grabbing of treasuries. Thus, that 1.67%, that 1945 low I've alluded to, in which we did kiss on September 23rd, is going to get taken out again, and that's where we could get some serious HFT action. You can see at 10-year, 1.5%. And at the end of the day, folks, this 10-year situation underneath 2%, it's good. It's not good for the economy. It's not good for annuities, pension plans, retirees. So it's very damaging in that regards. Hopefully, if you can get qualified on your mortgage, you can refinance, and that's a positive. But right now, we're seeing these rates hunkered down low, and Ben Bernanke alluded to the fact earlier this week that these rates are going to stay low through 2013. So we foresee no tightening in 2012. But the trade right now is to stay in the treasuries and watch for buying opportunities when those prices do relent. From the floor of the CME Group, I am the Killer. Have a great day. And one other thing you have to remember, be the hammer, not the nail.
Every day I'm shuffling.